Tyler, one note I just saw in my notes, and I want to make sure I did not miss actually, was you had some comments on interest rates and the dollar. While we're on broad market analysis, I did. I was really interested in what you were saying earlier. Can you share those ideas with the team and your thoughts on what's happening with interest rates today?
Yeah. So when you look at inflation, so a long time ago I learned about intermarket analysis, the relationship between inflation and interest rates and stocks. And on Wall Street, you hear about the CPI, the Consumer Price Index, which is just the industry standard for what is inflation doing. But what you want to pay attention to is when assets start to change their behavior, it can help you to see that Wall Street is kind of shifting expectations. And so you've heard for a long time, hey, stimulus could be inflationary. When inflation goes up, interest rates go up because debt investors demand compensation for the opportunity cost of lending money to somebody. So fundamentally, when you see interest rates start to creep higher, that is Wall Street starting to price in more inflation. And so just the reason I bring this up is yesterday, I actually just finished refinancing my house. And yesterday my lender, my mortgage guy called and said that mortgage rates and mortgage-backed securities went up. Interest rates went up a lot yesterday. So you not only saw a massive shift into small cap stocks and into these areas in response to the expectation of more spending and more stimulus, you also saw that in the debt markets, which impacted interest rates. And so not only did it impact mortgage-backed securities and mortgage rates, but we usually view things through the prism of treasury bonds and the yield or interest rate on treasuries. So if you look at any kind of bond price or bond ETF like TLT, which is a long-term bond ETF, you can see that this has fallen out of bed the last 2 days. And that tells you that long-term interest rates are going up, right? Bond prices and bond yields move in opposite directions. So pretty big down move here in long-term bonds. You can say the same thing in like intermediate term bonds, like IEF is an intermediate term bond ETF, breaking some pretty significant support levels. And so the corollary to that is if you go look at interest rates, your TNX is the 10-year treasury yield, which is kind of the go-to benchmark for interest rates. You can see this thing breaking out, right? So you're starting to see interest rates really increase in momentum to the upside, which you could argue again goes along with the inflation theme. Wall Street's starting to perk up a little bit. And in addition to stocks obviously doing very well because of stimulus, you're starting to see ripple effects in the cost of capital with interest rates and such. So, so far it's interesting. The doomsday scenario is eventually inflation is going to kill us all and interest rates are going to be a gajillion. Yeah, we'll see. But the market is waking up to this, Tim. You're starting to see a change in trend when it comes to interest rates.